Okay. Here you can see uh, I, based on my hypothetical scenario, I developed, I only forecasted financial statement up to 2030. Here I forecasted financial statement only up to 2030. From 2030 onwards, I didn't forecast that ABC PLC company financial statements. Okay. Then actually, in practically also, we can't, actually there is limit that we can forecast our financial statements. Okay, because forecasting the financial statement not each, as I told you, we need to consider about the many factors. Okay. Therefore, and also other thing is that especially for the growing companies and growing as well as for the mature company also, whatever type of the company, it is not possible to forecast financial statements from at least minimum is the 10 years. From the 10 years forecasted period, it is okay because we can't predict our future. No? Then other thing is then most of the business organization after, if it is a growing one after 10 years, it will be mature one, and from here onward they don't have higher growth rate. Actually their growth rate become to the some stable level. Therefore, it is not a need to focus their financial statement beyond there. And also for the matured company, yeah, also matured company already they have stable revenue. Therefore, for like that company, we don't need to focus their financial statement at least for the 5 years because their growth rate is a stable one. Okay, then, but for the growing company, then yeah, it's needed to focus minimum 5 years. Okay, because they are, if it is a growing one, their revenue can be grow each year. Therefore, it is needed to. But maximumly after 10th year, then their revenue will be become stable. Therefore, it is not needed to focus their financial statement for each forecasted period. Okay, for the each year. Therefore, when we forecast our financial statement, the period that we can forecast, then for the period that we can forecast, we call this period as the explicit period. We call this period as the explicit period. The period that we can forecast our financial statement. Then for that period, we can forecast our financial statement, and based on that, we can derive the free cash flow to the firms. But period beyond the explicit period, that means periods beyond the 2030, periods beyond the 2030, we don't have forecasted financial statements. But this organization may operate their business after 2030. Then if we derive the value only based on these figures, it is not okay. Okay, because this organization may continue their business operation after 2030. Therefore, then for the period beyond the explicit period, we need to identify their business value, but we don't have ability to forecast their financial statement. Then for that purpose, we can calculate the terminal value. We can calculate what? Terminal value. For the implicit period, then time period beyond the explicit period, technically we call that period as the implicit period. Okay, technically we call that period as what? Technically we call that period as the implicit period. Then for the implicit period, we need to calculate implied terminal value. Then how can we calculate this implied terminal value? Simply, we can calculate our terminal value. Simply, we can calculate our terminal value. Then cash flows at end of the explicit period. Cash flows at end of explicit period, multiplied it by 1 plus G. 1 plus G. 1 plus G means growth rate. We need to identify growth rate for our business for the implicit time period. Normally, as I told you, then for the growing companies also, after 10 to 15 years, then it will become stable. Their growth will become stable. Therefore, we can't predict or we can't assume higher growth rate for their business. Okay. Therefore, when we calculate the terminal value, practically we assume this growth rate is same or lower than the global or their country GDP growth rate. Normally we use their global or country GDP growth rate. okay, because we can't go beyond the country or global GDP growth rate, no, because that is a normal condition. It's a normal economic condition. We need to, as I told you, every moment when we build a model or when we identify the business value, we need to consider about our general economic conditions. Okay, therefore, here for the growth rate, we normally use global GDP growth rate or the country specific growth rate, nearly 2 to 3%. Then we can say this as a nearly 2 to 3%. Okay, then for your examining purpose, you don't need to identify the growth rate. Your examiner will directly give the growth rate. Okay, therefore you can use whatever the your examiner provide one. Then you can use this one. Okay, then cash flow at the end of the explicit period multiplied it by 1 plus G divided by WACC minus G. Then we need to divide it by, from WACC we need to deduct G, growth rate. Then finally we can get what? Terminal value as at end of the explicit period. As at end of the explicit period. Okay, this is the formula that we can use to calculate terminal value. This is a simple formula. Okay, this is a simple formula that we can use to calculate terminal value if we apply the discounted cash flow method. Cash flow at end of the explicit period multiplied it by 1 plus G divided by WACC minus G. Divided by WACC minus G. Then we can get the terminal value end of the explicit period. Okay, then let's see calculation of the terminal value for my hypothetical example. Okay, here for my hypothetical scenario, we calculate the free cash flow to the firm. No, then we have calculated it under the free cash flow identification part. Then we can see as at end of the 2030, our free cash flow to the firm is how much? 158,452. Then what's the formula that we can use to calculate the terminal value? Cash flow at end of the explicit period multiplied it by 1 plus G divided by WACC minus G. Then here, let's assume our growth rate as 2% for my calculation purpose. Okay, for my calculation purpose, let's assume my growth rate is 2% and WACC, cost of capital, WACC as 20%. Then let's assume like this. If we assume like this, then we can calculate terminal value for this given detail. Then how can we calculate terminal value for this given detail? Cash flows at end of the 2030, that means 158,452 multiplied it by 1 plus G. 1 plus G means 1 plus our growth rate is 2%. No, 1 plus our growth rate is 2%. 2%. Then divided by what? Divided by WACC minus growth. Then our WACC is WACC means 20%. Then 20% minus growth rate is 2%. 2%. Then we can get what? Then we can get terminal value. Then how can we calculate this one? Our cash flows as at end of the 2030, that means explicit period. Then for this period, we can call as our explicit period. No, the detail available, forecasted detail available. Then beyond the explicit period, we call it as implicit. Then here, as at the end of the explicit period, our free cash flow is 158,452. Multiplied it by 1 plus G. 1 plus G means growth rate. 1 plus 2%. Divided by what? WACC minus 2%. Then here our WACC is 20%. Then our growth rate is 2%. Then using this formula, then we calculated our terminal value as at 2030. 30 as how much? We calculate cash flow terminal value as at 2080 at 897,894. Then simply we can say this is the business value for beyond the explicit period, or we can say business value or the cash flows of the business for the implicit period, or the implied we can say as the terminal value. Simply we can get the terminal value based on this formula, and then finally we can get our total cash flows as a summation of free cash flow to the firm at this terminal value, total cash flow. Then we can get as a what? We can get as summation of free cash flow to the firm plus terminal value of year end. Then we can identify their total cash flows for each year like this. Okay, then this is the simple. This is the way that we can calculate the terminal value. Actually, terminal value calculation is not harder thing. It's the simplest thing. Then using this formula, simply we can calculate the terminal value. Okay, then as I explained, what's the rationale behind this? Then for any type of the business, even for maturity one, even for the growing one, at least after their 10th year, then their growth will become to the stable. They can't report at higher growth rate. Therefore, it is not practical to forecast financial statement for that for the longer period. Okay, normally minimally 5 to 10 years we forecast financial statement. Then beyond that forecasted period, we call as the implied implicit period. For that implicit period, we need to calculate terminal value. Then this is the formula that we can use to calculate terminal value. And here for my hypothetical example, I calculated my terminal value for the implicit period as 897,894. Okay. Then when we perform valuation, definitely we should have identified terminal value based on the given detail. Okay. Then I hope you got the understand about the terminal value calculation and rationale behind the calculation of terminal value.